So this is, been looking forward to this panel. I think the last paper kind of sets up the issue of CSR and impact investing quite well. So to my left is Ron Gilson. I think Ron and I are, we've both written a paper on this general area, but we're kind of dipping our toes in the water. The two experts are to my right, Rob Sitkoff and John Loder. John Loder is a partner at Ropes Gray and is a practitioner dealing with the investment management industry. And Rob Sitkoff, as probably many of you know, is a professor here at HLS and is a world expert on trusts and estates. And I thought we could start off our discussion maybe focusing on impact investing, CSR, corporate social responsibility, or maybe I should say ESG, in the context of ERISA, in the context of trust. So what can or can't a fiduciary do in that space, and also what should they do from a more normative perspective? So maybe with that, I will hand it over to John.
All right, thank you very much. The presentation that we just heard before lunch about the Morningstar ESG rating system was interesting. There was a phrase that was used in part of their descriptive material about aligning your investments with your values. And it's perfectly fine for me when I'm investing my own money to invest it in accordance with my values and whatever ESG principles, objectives, biases, goals that I might have. But the issue is a little bit different if I'm managing somebody else's money and thinking about applying ESG considerations of various kinds to doing my job of managing somebody else's money. So what we're going to talk about for the initial portion of this presentation is the set of legal rules in the US that constrain money managers' ability to use ESG as a tool in managing their clients' money. And as Alan mentioned, we'll talk about a variety of contexts, but the first one that we'll touch on is the management of retirement plan assets. The retirement plan asset market in the United States is a $28.2 trillion market, so a very significant portion of the overall assets invested in the public securities markets in this country is held in retirement plans of various kinds. I'm going to focus, for purposes of illustration, on the plans that are subject to a particular regulatory scheme called ERISA. That's the Employee Retirement Income Security Act of 1974. It covers essentially corporate and labor union pension funds. And those two segments together had, as of the end of 2017, $10.2 trillion in assets. So the fiduciary principles of ERISA affect more than $10 trillion worth of investing in this country. ERISA was an act of Congress passed in 1974 that has as its central idea the notion that when a corporation or a union establishes a pension fund, the assets in that pension fund do not belong to the corporation, do not belong to the labor union. They belong to a separate trust that is to be administered in accordance with a very stringent fiduciary principle that's set forth in ERISA. Let me outline the elements of that principle because they're going to affect how we can think about this issue with respect to those $10 trillion in assets. So ERISA establishes a fiduciary duty for the people who are running that pension fund. They are obligated to discharge their duties with respect to the pension fund solely in the interest of the pension participants and beneficiaries. That's the first element, solely in the interests of the participants and beneficiaries. Second, for the exclusive purpose of providing benefits to participants and beneficiaries. Third element, the people running the plan have to act with the care, skill, prudence, and diligence that a so-called prudent man would use. And fourth, the plan has to be sufficiently diversified so as to minimize the risk of large losses. So if you are involved in administering a pension plan that's subject to ERISA, you're subject to these duties. You're subject to enforcement action by a lawsuit of the beneficiaries or by the Department of Labor for violations of the fiduciary standard. And I would just say that this standard applies to essentially all aspects of the operation of the plan. So if an asset management company is hired by a pension fund to manage a segment of the portfolio, it has to manage the portfolio in accordance with these standards. If the pension fund is a so-called self-directed plan, where the participants in the plan get to choose how their share of the plan's assets are invested, the people who are running the plan typically will set up a menu of investment options that the participants can choose among, and the act of establishing the menu of investment options for the plan participants is itself an act of fiduciary discretion that's subject to the requirements of the standard I've just outlined. And similarly, in managing the aspects of the portfolio that involve engaging with company management, so proxy voting, deciding whether to take an activist stance, those activities are also subject to the fiduciary standard. We're starting with this category of assets in part because it's a substantial one economically, but also in part because it's been in the news recently. The Department of Labor, which administers this statute and enforces this statute, on the 23rd of April issued some guidance. Its third set of guidance in the last 3 years on the topic of how ESG factors may be used by ERISA plan fiduciaries in managing the plan. And to give just a very brief summary, what the Department of Labor said essentially was, you may factor ESG into your economic analysis, but you are constrained to maximize the risk-adjusted returns to the beneficiaries, and you are not allowed to use ESG factors if the result would be to compromise the return opportunities for the beneficiaries or to materially increase the risk of the investments for the beneficiaries. So the idea that pension funds ought to be managed in pursuit of ESG goals runs into the constraints of the ERISA fiduciary rule with respect to those $10 trillion of assets. So I'm going to stop there. I think my colleague has some additional comments on the matter.
Okay, so thank you, John. My tasking was to finish the legal context, talk about trusts and charity, and then to stir the pot a little bit. So let me do each. The fiduciary duties you just heard described, the sole benefit rule, which is a duty of loyalty. You must act solely for the benefit of the participants. And the prudence rule, you must act as a prudent person would in similar circumstances. From ERISA, those duties derive from trust law. Those are the duties applicable to a trustee of a private trust. Private trust is not tens of trillions, but it is over a trillion. For certain, to put this in perspective, private trust companies in South Dakota by itself has $250 billion in trust assets. And then charities are subject to the same prudence rule under a Uniform Prudent Management Institutional Funds Act and loyalty rules that are similar or slightly different in ways we'll come back to. And charities, I'm talking about the investments of things like, say, the Harvard Endowment would be subject to a similar kind of prudence rule. Okay, so let me then set something up to stir the pot. I want to suggest that when we say ESG investing motivated by environmental, social, governance factors, conceptually, we may be referring to one of two really distinct kinds of investment programs. So on the one hand, it might be that I'm looking to ESG factors for the collateral benefits that they confer, collateral to my risk-adjusted returns. Right? I'm going to call that collateral benefits ESG investing. That's not my, it's sort of my term, but the phrase collateral benefits is in the DOL guidance. And then another version, and let me say collateral benefits ESG, this is really just a rebranding of SRI, of socially responsible investment. Okay. Another version of ESG is using ESG factors as part of a multi-factor asset pricing model that you think will help you identify ways to get better risk-adjusted returns, or as considerations in your active shareholder engagement of how you vote or how you engage with the company, what you are looking for. And I want to suggest that as a fiduciary matter, and now I'm speaking not about can I make an ESG fund, but rather can I as a pension fund manager or a trustee or a charitable fund manager or as an ERISA menu builder, can I use ESG factors to motivate me? That it is completely consistent with the duty of loyalty to do risk-return ESG. To use these factors, just like you could use any factors that you have a legitimate basis to think has a asset pricing relevance, but that it is, under American law, violation of the duty of loyalty to pursue these factors for collateral benefits. It's not a new conclusion. This is the same conclusion the literature reached decades ago during the apartheid divestment, and now it's back, except that social responsible investment has been rebranded ESG in this confusing way that you could be said to mean returns or collateral benefits. And in the last panel, we heard about the PRI, which is the Principles for Responsible Investing, which comes out of a group that is sponsored by an arm of the United Nations. The PRI materials are not always clear on when it's collateral benefits or risk return. And it's often framed as there's evidence of risk return, therefore you should do this, and we get collateral benefits, which in the fiduciary space is an awkward place to be because you're inviting a loyalty kind of dispute. Okay, so let me then suggest a couple of things. So one is a fiduciary perspective, and this would be true, I think, for all investors, in thinking more concretely about how we might go forward with risk-return ESG investing versus collateral benefits. I want to suggest just a couple of things. So one is ESG, as we heard in the prior panel, there's not a unified view on what ESG factors are and which ways they point and how much to weight them. Okay, so let me give an example. Is nuclear power a pro or a con? BlackRock takes the view that ESG requires 2 women directors on the board. Why not 3? Why not half? Classified boards, could it be good, bad? I don't know, I think we all have a sense. Okay, so one problem is that these factors point in different directions subjectively, and then how do you weight them? Right? What about a fossil fuel company that's that's a completely diversified board of directors? Right? This is not meant to be an ESG criticism. This is just active investing. It's subjective. The investor must make subjective judgments about direction and weight and how to balance these things out. Right? Okay. So then let me bring this back into the fiduciary space, and I'll stop here. It is often suggested that collateral benefits ESG, risk-return ESG, this may not be a real distinction. That why can't I account for these other benefits? Maybe that's what the beneficiaries want. Maybe that's what they're asking for, right? Maybe the plan participants are seeking this, or maybe it's consistent with the purpose. And so I want to suggest a heuristic for how to think about this kind of a debate. It is to ask, suppose instead that objective were presented to you for distribution. So you're the trustee of your Northern Trust Company. The beneficiaries say, look, we want you to do this investment program for environmental grounds. Could you make a distribution out of the trust? Could you make a distribution for those grounds? If you couldn't, it's probably inconsistent with the donor's intent. Why can you smuggle it into the investment function? That's kind of an American way of thinking of this fiduciary obligation. The investment function can't be used as a substitute for purpose, right? So we have a variety of education, environment. There are different things that can be charitable purposes. When you're managing a charity, if I'm the Sierra Club, when I choose not to invest in fossil fuels, that passes my test of could I do that as a distribution. It's not that it's an exception to the duty of loyalty. It is that the collateral benefit investment is consistent with the duty of loyalty because loyalty is to the purpose. Right, okay, so that's the suggestion. I promised I would stop for these guys, and there you go.
This works. I'm going to take just a very short time to make a point that's different than John and Rob has made. I want to talk about it not from I want to talk about ESG, about socially relevant investment, not from the perspective of what the legal rules are, but rather from what it is that an investor can expect. Because my experience looking at this is that the language that is used to present the opportunities to investors, I think the most accurate, the most friendly statement is that it's inaccurate, and in other circumstances, it reflects the fact that good-hearted people care a lot about this, and the sell side of the market will sell them anything. So I want to, and I'll briefly, but I'll describe the concerns that I have. The first thing I want to draw a distinction between is two different things we may think we're accomplishing by investing with a sense of social purpose. The first one is kind of easy. That is, it's value alignment. We talked about it in the session before. Our own moral sense doesn't come with a dotted line, so that the way we live our life is somehow different than the way we construct our portfolio. We're integrated people. We believe one set of things. That seems easy. For years, the major foundations in the United States separated out their programmatic function from their portfolio management function and did things that were astonishing disagreement from each other. One category. Second category, and the second category is instead of value alignment, it's value creation. And out of it comes this notion of impact investing. The claim there, and the part that's hard, and I'll come back to briefly, is a claim that through your investing, you can cause an increase in the value of the social good that you care about that would not be forthcoming any other way. Simplest way to put it, you're willing to provide capital to someone trying to build out mobile phone networks in Africa because you think that will do a really good job, and you're prepared to provide capital at a rate that's beneath what they could get any other way. So you can, in that kind of simple world, your notion is you will make a concession, and you will therefore you'll be able to show that you've created value as a result of that. In both categories, value alignment and value creation, there's both a concessionary category and a non-concessionary category. In one, you're giving up some level of return, whether it's directly in return or in a value alignment, you're giving up some level of diversification in order to accomplish a consistency between your portfolio and your ethical values. In impact investing, the issue is, are you expecting to both create social value and to secure a market level risk-adjusted return? What I want to suggest, the result of thinking about this leads, I think, to two conclusions. One is that for most of us, investing in a mutual fund, investing in secondary market transactions, we can align our investments, and we can probably do it without very much tracking error to an otherwise unconstrained portfolio. But what we can't do is affect the behavior of the company in whose shares we're investing. Not through secondary market transactions, without the assistance of other stakeholders who may have a whole lot more clout than the investors do. On impact investing, it's a private equity model. The transactional arrangements are pretty similar. limited partnership, general partners getting get typically 2% and 20. Here's the part that causes me to be skeptical. The first is, and I'll use as an example the TPG is now marketing. It's on the order of a $4 billion impact investment fund, along with Bono, who's a partner in the arrangement, and they're charged with doing two things because they're shooting for risk-adjusted market returns, no concessions, and they're committed to creating social value as a result of it. Everybody will remember, I suspect, Bengt Holmström's paper essentially saying that when you have an agent who's being asked to do two different things, and the agent is only being paid for one, you're going to be really skeptical about getting the other. The payment to the impact investment general partner is measured with only a handful of exceptions across the investment universe, is measured solely by financial returns, not by impact, not by the social impact that's created. Now, as a transactional matter, and for some of the people who are doing contract theory here, it is an interesting transaction to write a compensation contract that both has a measure for impact investment and whose ambiguity doesn't shove too much risk on to the general partner. But the simple answer is the payoff to the general partner is, with very few exceptions, entirely based on finance, and that ought to make you skeptical. Second point, the benchmark to which you compare the promised market return in an impact investment fund. You may just make sure, because it's very messy, the right discount rate is the discount rate associated with other private equity investments that reflect the significant lack of liquidity that's built into an impact investment, a private equity impact investment fund. The third thing is to read very, very carefully, particularly in the mutual fund space, the marketing material for ESG-styled funds, because all too frequently it will shift between what I've been calling value alignment and value creation without any friction. And if someone is telling you that they're going to create value through secondary market investments, you need to be extremely skeptical. And if you're looking at it, if you're working with a foundation and you're looking at a impact investment limited partnership, if there is any secondary market transactions expected to be in the portfolio, put the document down and put it away.
So I'm not going to say much, but I will mention a set of experiences I had. For my sins, I was the chairperson of, I'm trying to remember the official name, the Harvard University Shareholder Advisory Committee. So we were charged with voting the proxies on shareholder responsibility of shares that the Harvard Endowment held. And this is going to lead to a question for John and Rob. One thing I observed in that, and this was for 4 years, one thing I observed is companies that tended to be a mess in terms of their ordinary business operations tended to be a mess on the things that came up in that context. So for example, one big issue was, does the firm have a carbon emissions plan if they're the type of firm that would generate a lot of carbon emissions? Well, the firms that didn't have such a plan tend to be the firms that were a mess in lots of other ways. And firms that tended to have, I know, obviously this is a generalization, firms that tended to do a good job there tended to be well run in other ways. At least that was my anecdotal sense. And the paper that I have done in this space, we had a paper last year in the GFE where we show that, where we use Jensen-type measures of agency problems like free cash flow, and we show that firms that were better managed, i.e. have lower agency costs using kind of the Jensen-type measures, also tended to do better using standard ways to measure ESG. So that was my anecdotal sense, and then that was reflected in the paper. Now my question for Rob and John is, in all those years of discussion, of talking about how the Harvard Corporation should vote on various shareholder proposals, risk return never came up, not once. It was about what's Harvard's values, what's Harvard values as expressed in its institutional history on voting on these matters. It was all about the values and whether they're consistent with or would suggest that Harvard should vote in favor or against. So again, my question for Rob and John as well is, we never talked about risk and return, never came up. We didn't do any papering either to dress it up as a risk return analysis. So was I violating the law when I did that?
So, yeah. So, let me say three things about that. So the first is that as a theoretical and legal matter, Harvard as fiduciary has a wider range than a private fiduciary, because Harvard is a charity for a charitable purpose. And so determining whether or not the considerations you looked at were consistent with the charitable purpose of the organization is a fuzzier question than if you were an ERISA fiduciary or a private trustee. That's a legal point, that there's just more give there. Then there's a practical enforcement point, that charitable enforcement is done at the state level by the AG, the aspiring governor, the attorney general, whatever, same thing. It is not, charities don't have the same kind of litigation risk, because the only party withstanding normally would be the attorney general. It's not at all clear that the attorney general of Massachusetts, that the path for the attorney general to becoming governor is by suing Harvard because of how you voted in your meeting. So that's right, as opposed to, right, okay. So
although in some states it could be.
I get that, right? I'm saying, but in terms of, so, you know, as your lawyer doing risk management, part of the question is, what's the underlying merits of the claim? And then part of it is, what's the realistic likelihood of the suit being brought? Okay, then the last thing I'll add, which is the underlying point you made of the correlation between management quality and scores for ESG. So this is a point that's emphasized in the literature and that PRI points to. This is the story for why ESG might be a valid risk-return active investment thesis. One of the stories is that ESG scores may proxy for management quality. Maybe they proxy for management quality because if you're good at that, you're good at other stuff. It might also proxy the other way. It might be good managers are attracted to firms that have good compliance. That's a distinct question, though, whether there's a relationship here in firm performance, whether that firm performance has been priced accordingly so that I can stock pick and score, or maybe I use that in my voting, which is what you're doing, right? Voting is more a question of firm performance.
Just to pick up on the point that Rob made about enforcement, I completely agree that in Massachusetts, where I happen to live, the Attorney General is extremely unlikely to go after the warm-hearted advisors to the Harvard Pension Fund with respect to their proxy voting. But in the ERISA context, it's interesting to observe the change in the tone in the guidance on the use of ESG factors in, sorry, did you have a question?
Why does this guidance have any legal weight at all, particularly given the now position that the GAO has taken about guidance?
Well, because I mean, the point I was about to make was it signals potentially the attitudes that the staff at the Department of Labor will bring towards possible enforcement cases.
It's really, there are two levels there, right? So one is the DOL guidances give you a clue about the enforcement priorities
Right.
of current leadership in the department. So every time there's a new presidential administration and the new ESG guidance comes out, all of the kind of the dicta, all of the atmospherics give you a sense of, is this a hostile or a friendly administration? So that goes to the probability of enforcement. And then you're asking, I think, a legal question: what kind of deference does the court give DOL guidance? These are not Chevron notice and comment rules. It's a MEAD. It's a weaker threshold, and this is a different conversation about whether or not these DOL guidances are sensibly constructed and ought to get deference by a court.
I'm going to do the same thing I did before, which is ignore the legal rules for a moment and talk about what it is one might be trying to accomplish. And the example I'm going to use is the one that Ellen used, fossil fuel divestment. I learned something about how to think about this from Patrick Bolton, a colleague at Columbia and first-rate economist. And what Patrick did was he changed the question. He said, why should I be concerned about fossil fuel producers? I'm concerned about that because they produce carbon. So why shouldn't the strategy, instead of picking particular parts of my portfolio, why shouldn't I try and reduce the overall carbon footprint of my portfolio rather than just pick a particular thing? So Patrick created both benchmarks and operationalized a portfolio strategy, which he then made available. And there are a number of Swedish pension funds that are using it, in which it reduces the overall carbon footprint by something like 40%, and at least looking with backward testing without a significant tracking error. Now, my point about raising it that way is that let's assume for a moment that because we're a charity, we've got more flexibility. The question becomes, how do we frame what we're trying to accomplish? And the experience, I think, thus far is that the framing of it tends to be awfully unsophisticated. That is, it gets termed, universities, it gets termed and pick out whatever cause you're not supposed to. We don't want to hold the securities of a particular producer, as opposed to looking at what our overall portfolio does with respect to that element, and direct it at the portfolio level rather than at a single point. Now, it may be political, it may be responses to different constituencies the organization is subject to. But in most circumstances, my guess is framing it as divestiture of a particular producer or kind of producer will be a narrower framework than if you were looking at your overall portfolio and how can I adjust that portfolio to minimize whatever the nasty thing I don't want to support is.
So, Ron, it's interesting, the idea of having a carbon neutral portfolio has been brought to the retail market within the last couple of years by one of my clients, an organization French-based called Natixis, and it has designed a series of target date funds for use in retirement plans it's a sustainable future, it's branded sustainable future, and they have a 2020, a 2025, a 2030, and so on out to 2065 for people who are anticipating retiring in those years. But that kind of raises the interesting conflict between the strict form of the fiduciary rule and the risk of incurring enforcement action for violating it, and the preferences of the beneficiaries of some of these arrangements. So it's interesting to ask whether it's permissible for a fiduciary who's held to a strict form of the sole purpose and prudence rule to cater to the desires of younger investors who we heard in the earlier panel are clamoring for more ESG sensitive investments. Is there a question?
You know, I have a little bit of trouble knowing.
You were on the Columbia.
I was the chair of the Columbia Advisory Committee on SRI. You know, the divestment issue that we face, and we divest thermal coal, but nothing else. And so the economic, and so there was symbolic speech and economic action. And the argument put forth is the real risk was denial of the climate change risk. And so the university, as a speaker on behalf of science, could take this position. But when it came to, you know, the economic case, which was really more for the trustees than for our committee, you know, there was no trouble in saying, in sketching out an economic case in which the failure to take account of these risks would have long-term effects on a, you know, on a diversified portfolio of investments that was supposed to fund the university over a very long period of time. And so in the context of ERISA, for the same reason that any business lawyer worth his or her salt could construct a business case for anything the board of directors wanted to do, I find it hard to see why you and Rob are having trouble imagining that an ERISA fiduciary couldn't frame actions that had an ESG dimension robustly in terms of the long-term economic performance of the portfolios and risk mitigation and, you know, all the things that lawyers, when they want to, you know, draft a very broad statement of objectives are able to do. So that, I mean, there may be, the trustees may or may not want to go in that direction, but the idea that there's a legal constraint on it is, I guess, the question that I've got.
Sure. So I think you make a good point, which is that a very large amount of the answer here depends upon how the decision is characterized, explained, justified in the record. And I'd go back to the language of the statute, which talks about the assets having to be managed for the exclusive purpose of providing benefits. So purpose really goes to the state of mind of the people who are making the investment decisions, and to the degree that you can in good faith characterize the purpose for the decision not to invest in coal as being compatible with the economic motive, I think you're fine. On the other hand, if you trumpet it as some kind of something else, you're perhaps undermining the foundation that you'd like to have to defend the decision against a possible challenge by beneficiaries or the department.
So let me use two examples. So one is Stanford got a lot of positive attention for divestment from fossil fuels. If you read really closely the Stanford webpage about divestment, it says that there's only one form of fossil fuel that is so ethically objectionable that it would have to be divested on moral grounds. That's collateral benefits ESG. But as it happens, says the webpage, our portfolio didn't have any of that in there already based on our risk-return construction. And on a forward-looking basis, of course we use ESG in our models. We look at every relevant factor in our model. That's more or less what it says, right? So why am I using that example? I said marketing versus what do you actually do difference. So let's bring it back to ERISA and personal trusts. They're two different tensions. So on the one hand, I might, as the fiduciary, I might myself have a disloyal motive. I might really care about some social, environmental, whatever objective, and I want to use this money over which I am fiduciary to advance that objective. And so I want to use these factors in my investment program, and I paper that over with risk-return analyses. Right? as a fiduciary, I have a duty, an ongoing duty of periodic return and reallocation and constantly reviewing and review again and review again. And so I'll have to continually paper this over to show that. And on some level, I might be a bad person, but if I act good all the time, I'm a good person. I may have this, there might be this secret in my back of my heart, disloyal motive, but if I'm constantly using a risk return measure. But that's not really the tension on the ground. The tension on the ground is you have participants or in a personal trust beneficiaries who are asking for this. And the difficulty is about your liability, risk exposure to other participants and other beneficiaries. This comes up in two ways. In the personal trust way, you have an intergenerational, multi-generational, down the generations trust created by grandpa long ago. Now a millennial generation is coming of age, and they're knocking on the door of the trust company saying, look, we want you to invest on these criteria. Criteria that are collateral to the terms and purposes of the trust. So you're the trust company, what do? You want to build a risk-return model to justify that, maybe, but you do want to keep these beneficiaries placated by pointing to the collateral benefit. If you point to the collateral benefit, you've just set up a claim by the next generation that you were because you couldn't make a distribution to the current generation for this purpose. Why can you run the investment program for that purpose for the current generation? And it's this business risk versus fiduciary risk that that the trust companies feel tension. In an ERISA framework, the way it arises is menu construction in the defined contribution plan. And for private employers, the defined contribution plan is dominant. So step back. Defined benefit is what people used to think of as a pension. You just get a certain amount periodically. Defined contribution is what most private employees have now. You have a menu of investment options in which to put your money. So the fiduciary gives you that menu. So what should be on that menu? Well, could I, if I'm Harvard's fiduciary, I'm Harvard, deciding what goes in the Harvard menu, could I put an ESG fund in there? I surely could if I thought it was a good risk return option. Could I put it in there because I thought it had good collateral benefits? Could I put it in there because I think a lot of my employees want to see collateral benefits and want that option? One of the tensions is the social science literature that shows people are really bad at choosing from these menus. They do naive diversification. You give them 4 choices, they'll put a quarter in each. You give them 10 choices, they put 10% in each, because they think that's diversification. There is a lot of litigation right now in menu construction, ironically, arguing that these menus are too big and that they have active funds on them that have too high costs, and that what the menus really should have is fewer choices with lower costs. Of course, runs completely at heads with having active ESG kinds of funds. So I take your point that I could paper over and have risk return story there. I just want to add, though, that that's a comforting backdoor loyalty protection, but it doesn't really respond to the problem of I also have to placate or satisfy my different constituencies that are asking for collateral benefits in a legal construct where I have to look at sole benefits that may not include what they regard to be important collateral objectives.
Quick question, Rob, and maybe for John as well. Are you telling me a court is going to come in and adjudicate whether the finance literature supports or doesn't support a particular ESG fund as having appropriate risk return profile? I mean, like who's going to decide this?
No, it's a fair question. No sensible person would say that the prudent investor rule requires the trustee to have down to the decimal point that I'm on the Markowitz efficient frontier and I've assessed risk tolerance exactly perfectly. But the extent of the size of the trust and sophistication matters. So Aunt Ruthie with a $50,000 trust that is 60-40 with reasonable funds is done. But the trustee of an ERISA fund that has $100 billion or $10 billion or even $500 million in it has to have a much deeper kind of analysis. And the problem is, if at the same time you're doing that analysis, you're placating a constituency in your marketing materials. I'm not making this up. Go to the Northern Trust or U.S. Trust Company's webpage, and they'll have an ESG section. And they're really trying to thread the needle when they say collateral, these other benefits versus risk return, because they don't want to create a trial demonstrative in the lawsuit by the next generation. This doesn't, look, it's really all about collateral benefits. It's on their own webpage.
One thing that perhaps we should explain, there's been a lot of conversation thus far about a set of detailed U.S. rules. And the question becomes, why do we spend this amount of time talking about a set of U.S. rules which are technical even for U.S. lawyers? Part of the unstated motivation for it, but at least I want to make the point explicitly, is that the U.S. market represents an awful lot of assets, as John indicated at the outset, and there will be a tendency when we study this market in ESG investing and the like, to want to do it, to include more than a single country. One of the messages is that in lots of areas, but in this one in particular, the local rules matter big time, which means that if you're going to work in this area, you need to either figure them out, have somebody available to you who genuinely knows them because they're technical, but they impact the sets of things that we would all like to measure as a matter of financial economics or governance.
I would just add from the perspective of somebody who actually has to advise people in this business, a big part of it really is making sure that they have thought carefully about the issues and construct a record that shows that they were appropriately careful and prudent in coming to whatever set of decisions it is that they come to. I think the risk of enforcement is relatively low if they can meet those hurdles.
Yeah, so this is really interesting. It seems like the discussion of whether or not you're in breach of fiduciary duty doesn't sort of capture everything we want to know. So there's good behavior over here, there's bad behavior that's not breach of fiduciary duty, and then there's breach of fiduciary duty and maybe criminal behavior somewhere over there. So the distinction is important. When are you in breach and when not? But we also need to think about, does the system deliver in terms of good versus bad? I think the financial sector has a mixed record. For example, has for a long time sold very expensive asset management services to households. I think you have to worry that sustainability is being pounced on by some financial firms as a way to sell overpriced services to households. And I think it's this segment of the financial sector has a strong interest in obfuscating their return properties of sustainable investment. So, for example, if I'm an investor, my return is the cost of capital of the firm. And so if I get a high return, that means the cost of capital for the firm is high. That means I'm not encouraging it. So you can flip it around. You can say, if I want to give sustainable firms a lower cost of capital, I've just committed to having lower returns. So that's a fundamental underlying all of this. The fundamental economics is, in the long run, you either have impact or you have good returns. So I don't think that's not a mystery. There's some footnotes to this, and maybe markets aren't pricing climate risk efficiently at this point. You can talk about that. But at the end of the day, in the long run, there's a negative trade-off between these two things. And so I think the concern here is that there's such a strong commercial interest in the financial sector to be unclear about this. What do you think about this?
Well, I think to the degree that commercial actors are going to price sustainable investing as a premium priced product, it does raise exactly the issue that you've just stated. I think the prior speaker had quoted the Pope to the effect that this kind of investing should lead to lower returns, and if that really is the case, there's a fiduciary problem.
I mean, I'll add that I take the point. I'm less concerned about it in the fiduciary space because of the fiduciary tradition of disclosure and release and so on. So by way of illustration, Bessemer Trust was a major American trust company with a really strong reputation, has developed an ESG capacity because it has beneficiaries and donors and others who want to do this. And the quants at Bessemer published an article in the Journal of Wealth Management or whatever, in which they showed that they purport to show that I didn't look at the data, they purport to show that their model beats the benchmark by whatever the delta is, and that when they overlay ESG into their model, they still beat their benchmark, but the delta is smaller. Which I think is a great story because that paper is, in any account in which they don't have direction or beneficiary consent, that paper is Exhibit A, that their motive for investing with ESG was collateral benefits and not risk return. So I said that to the folks at the risk management at Bessemer, and they said, yeah, that's why we're not putting anybody in it unless they specifically direct or ask for it, and if it's current beneficiaries, we get a release. And the fiduciary folks there said, look, it's a business risk and fiduciary risk balancing question, although critically in that place, it's in a context where all of the incentives of the firm are to make disclosure. The more that's disclosed, the lower the fiduciary risk, because the more enforceable, the more likely that release is to be upheld. And even more worrisome, when the next generation shows up to sue, you're more likely to accept that release down the line.
And to be clear, and this is kind of where we started, if I want to go hire an asset manager to manage my money and direct them to do it in accordance with whatever my criteria are, and I recognize that I'm going to sacrifice return, I can do that. The problem comes in some of these situations where there is a regulatory framework that is harder to reconcile with that goal, or in the case Rob gave of a trust, where the people who are the beneficiaries of the trust don't really have the legal authority to direct how the assets are managed.
Yeah, you've discussed weighting quite a lot, but you haven't really discussed engagement, and we know that funds also engage on ESG issues. I mean, that goes back to what Michelle said today and yesterday. So can you say something about engagement? Because presumably you can ask the funds to engage, and should they, and should you pay for this? So, what can you say in that dimension?
Well, so let's focus specifically on ERISA plans for a moment, because that's where we have the strictest form of this fiduciary rule. The recent guidance actually does comment at some length on the degree to which that kind of engagement can be done. It has to be motivated by the purpose of enhancing the risk-adjusted return to the portfolio. And there's a question about how much the asset manager can spend out of the assets of the trust in order to pursue that kind of an activity. So that has to be a cost-benefit analysis, which the Department of Labor suggests has to be quite carefully documented. I think there is a concern that some overzealous fiduciaries may pursue their own ESG goals, potentially at the expense of the economic return to the beneficiaries, and so the burden is on the fiduciary to show the justification for what they're doing in that economic sense.
The subsidiary principle, which is subsidiary of prudence, is a duty of cost sensitivity. So Aunt Ruth, the trustee of a $50,000 fund, shouldn't be spending $10,000 on proxy activity. But you might spend $10,000 on proxy activity in a $500 million fund if you think that's going to really protect the firm value and the investment. What the DOL was speaking of there is it wants to see that you've done that kind of analysis. But that's old trust law. I mean, that's just a traditional fiduciary principle of, generally speaking, you have to be reasonable. It's a cost-benefit trade-off.
Are there any more questions or comments from the audience before we break? Okay, so we'll take our break. The program's the timing's a little off. It works out, but we'll have a half-hour break, and then we'll have our last session, which is the normal 2 hours, and then we'll have the reception at 6 as reflected in the program.